Hi everyone! Asian stocks tumbled following a drop on Wall Street. Stocks went down after the release of the FOMC meeting minutes. Some investors considered the minutes less hawkish, which facilitated a short-term rise in stocks. However, the majority believes that inflation has not peaked yet, so they are expecting the Fed to maintain aggressive tightening. The US dollar index edged higher as anticipated. Meanwhile, the bears are trying to push the Australian dollar down. It means that the likelihood of a further decline is high. The yen also lacks drivers to resume an upward movement. Today, US initial jobless claims and the Philadelphia Fed index are on tap. Apart from that, presidents of Kansas City and Minneapolis Fed, Esther George and Neil Kashkari, are scheduled to deliver speeches. Asian stock markets were unable to recover as Wall Street failed to offset losses. However, the drop was rather modest, so there is no reason for pessimism. Besides, the current decline looks like more like pause before stocks climb again. As usual, the tone of the Fed minutes was neutral. They contained no fresh information. Perhaps they have reminded investors once again that it is too early to expect a shift to a dovish stance. Of course, there are signs that inflation has peaked, but without proof. Analysts also advise not to pin great hopes on a soft landing. Now, both an optimistic and pessimistic scenario is possible. However, this is a favorite topic of investors now who are counting on a positive scenario. The July FOMC meeting minutes showed that all policymakers backed a 75 basis point rate hike. At the same time, they have reckoned that the future rate increases would depend on macro stats. They also said that the regulator may slow down the pace of monetary tightening if necessary. Investors perceive this comment as a hint that the tightening cycle may be less aggressive than predicted. Yet, Fed officials confirmed once again that the central bank would raise the interest rate until inflation reaches its target level. Following the release of the minutes, investors began to price in a 50 basis point rate hike in September. This probability was estimated at 60%. Today, these expectations may change, as speeches of Fed officials could give traders new food for thought. The US dollar index is gaining momentum, yet the bulls remained slightly cautious right after the publication of the minutes. In the Asian session, the greenback was trading mostly at the same level. However, it made attempts to rise higher. A short-term target is located at 107.00. However, the US dollar has no drivers to touch this level and consolidate above it. If it breaks through this level, it could advance to 107.42. Nevertheless, there are no bearish fundamental factors in the US dollar now. It is expected to trade steadily until the end of the year. There are still many reasons for risk aversion, which is extremely beneficial for the US dollar. Tensions over Taiwan are mounting. Several warships remain near the island. Reportedly, the US and Taiwan will start formal talks on a trade and economic initiative in the fall. Reputable think tank slashed China's growth forecast. Bloomberg revised its outlook. Goldman Sachs Group lowered its projection for China's GDP to 3% from 3.3%. Nomura downgraded the figure to 2.8% from 3.3%. Thus, the forecast readings are now quite far from the government's target level of 5.5% set for this year. It increases the risk of global recession. The yen-dollar pair remained almost unchanged in the Asian trade. Looking at the chart, it is impossible to not to notice the dominance of the US dollar. Now the pair's trajectory mainly depends on the greenback's movement, so the uptrend is likely to continue. On Wednesday, the pair almost reached the short-term target level of 135.50. However, it failed to consolidate above this level. If the bullish bias for the greenback gets stronger, the pair is sure to rise above this level in the short term. A more distant target for the bulls is now the 140.00 level. The main drivers remain the same: the prospects for the global economy and the energy crunch in the Eurozone. Today, Australia revealed its employment data. July is a seasonally strong month for the labour market. So many analysts predicted sharp growth in the number of new jobs. They were anticipating an increase of 50,000 or 40,000. The most pessimistic scenario suggested a rise of 20,000. None of the forecasts turned out to be accurate. The indicator was rather weak. The employment rate went into negative territory as the number of new jobs plunged by almost 41,000. At the same time, the unemployment rate fell to 3.4%, although analysts did not expect any changes. Despite an improvement in the unemployment rate, investors were extremely disappointed with the employment indicator. This Don't Bear report adversely affected the Australian currency. Traders are now factoring in as 80% chance that the RBA will cut the rate by 25 basis points in September. The Australian-American dollar pair has been quite volatile this week. It halted its rise at 0.7146. The bulls failed to defend the 0.7000 level. It signals further decline. The next target could be the 0.6868 level. If the price drops below this level, it may tumble to a low of 0.6680. If the bears escalate pressure, the quartz could even collapse to 0.6461, which is the correction level of the uptrend of 2020-21 years. This is the most unfavorable scenario at the moment. A breakout of a high of 0.7146 will signal a resumption of an uptrend. In this case, the pair may move to the June high of 0.7282. However, a downtrend looks most likely over the next few months. Shrinking economic growth will force the RBA to carefully consider further steps regarding monetary policy. Traders have already factored in big rate increases. This is why the Australian-American dollar pair will hardly have any support, even if the RBA maintains a hawkish stance. Now investors are looking for clues about whether inflation has peaked. Any signs of it may indicate a more favorable scenario for the US economy and the global one. Judging by the dismal situation in some markets, it is too early to count on a steady recovery. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you!